In Chapter 2, we'll look at interest rates, the most important factor in determining the value of securities. When we refer to nominal interest rates, we're talking about rates you can observe in the market, the current rate on T-bills, the current 25-year mortgage rates. Interest rates basically determine the price of everything. Rates have two components: opportunity cost. All securities rates are dependent on rates available on competing investments. These rates will be a function of the underlying supply and demand of funds available. And there'll be adjustments for individual security characteristics, like default risk, maturity, liquidity risk, payment terms. They're different for different securities, so you'll have different interest rates on each. The real risk-free interest rate is not observable. We usually assume it's in the 2 to 4% range. The difference between the real rate and the nominal rate you can observe is inflation. See the question on the slide. If you wish to earn a 3% real return and prices are expected to increase by 2%, what rate must you charge? About 5%. The formula on the slide is called the Fisher effect. It states that the nominal rate is the real rate plus the expected rate of inflation. The loanable funds theory is basically a way of saying rates are determined by supply and demand. It should be no surprise that when there are more funds available, interest rates go down. Funds are scarce, rates go up. Pretty basic. Believe it or not, we are suppliers of funds through investments, savings, pension funds, etc. Government and businesses are the demanders of funds. We talked briefly in Chapter 1 about the role of financial intermediaries in bringing suppliers and demanders of users together. Here's your basic supply and demand graph. As supply, the dark gray-green line, goes up, the rate goes down, and vice versa. The equilibrium interest rate is at the crossing point. These four charts, Fed funds, T-bill, AAA-rated corporate bonds, and mortgage rates, demonstrate how interest rates move together in the economy. Slight differences, but basically the same pattern in all four graphs. Funds supplied, funds demanded, net funds supplied, minus demanded. A negative number in the last column represents a net demand for funds. The household consumer sector is one of the largest supplier or loanable funds, while financial businesses demanded the most funds. Households, us, we're the primary source of funds. So what determines when we supply funds and when we don't? Interest rates and tax policy. When rates are high, we're more likely to put our money to work. Income and wealth. More money to save, and still have plenty for living expenses. Clearly, perceptions about risk affect whether we invest, save, or spend. It's an investing-savings trade-off, immediate gratification versus the future. Credit availability. When credit is readily available and rates are low, we're more likely to use credit rather than spend personal funds. Job security and trust and entitlements. If you feel you're secure in your job, you're more likely to spend. Same with your trust that Social Security would be there, else you need to be saving for your retirement. Foreign investors also supply funds to the U.S. Foreign fund suppliers examine the same factors as U.S. suppliers, except they must also factor in expected changes in currency values, global interest rates, different tax rates, sovereign risk. There's typically some built-in demand for U.S. investments, however, because the U.S. is considered a safe haven, meaning a country with relatively low political and economic risk and a stable currency. High levels of reserves are indicative of foreign central bank activity to limit the growth in the value of their currencies against the dollar. This may be done to stimulate their export sectors. The dollars are often reinvested in the U.S., typically in treasuries. This provides an additional source of financing to the U.S. and helps remove a market discipline from U.S. borrowers. While businesses are the largest demanders of funds, the federal government is a big user as well. You can see on the slide how the national debt has grown in the last 4 years, from $19.21 trillion to $26 trillion. This money is in addition to the revenue the government receives from various taxes. Biggest user of funds, businesses. One of the biggest determinants of business demand for funds is interest rates. Think back to your 331 class and net present value. When interest rates are high, projects won't look as attractive. They may decide to finance totally internally from retained earnings or simply forego the projects. Risk versus return. More good projects is a higher demand for funds, higher interest rates. If businesses view the economy as positive, they're more likely to take on riskier projects and borrow to fund them. Here's how supply, demand, and interest rates react to a shift in supply. As supply goes up, interest rates come down. With lower rates, demand goes up and the equilibrium rate declines. Here's the reaction to a shift in demand. As demand goes up, interest rates go up. The quantity of demanded funds goes up and the equilibrium rate increases. Here's a recap of the factors that affect the supply of and demand for loanable funds. This chart details the impact of shifts in the supply curve. Note, interest rates, risk, and near-term needs directly impact rates. Total wealth, monetary expansion, and economic conditions shift the supply curve up, so the effect on interest rates is inverse. They go down. Here's a recap of factors that affect the supply of and demand for loanable funds. This chart details the impact of shifts in the supply curve. As the demand for funds increases, assuming supply stays constant, interest rates increase. Improving economic conditions increases the demand for funds. As you get more pleasure from items bought on credit, the demand for funds increases. Restrictiveness of non-price conditions refers to restrictions put on borrowers to access funds. The less restrictions, the more market participants are willing to borrow. This table is a version of Table 2.2 in your text and details the impact on the supply of and demand for funds and interest rates from changes in various factors. Direct means if one goes up, so does the other, the blue cells. Inverse means they move in opposite directions, the orange cells. So if interest rates increase, then supply goes up, demand decreases, and rates change directly, going up. Wealth increases, then supply increases with no evident impact on demand. With increased supply, rates change inversely, decreasing. Increased risk causes supply to decline as investors are less willing to invest in riskier assets. Demand also declines as borrowers are less willing to borrow. With decreased supply, rates increase. Increased immediate spending needs causes supply to decline and rates to increase. Increased monetary expansion increases supply and inversely impacts rates. And finally, an improved economy affects both supply and demand curve and inversely affects rates. This is the final part of the table. Utility derived means your satisfaction or pleasure from buying something. As utility increases, the willingness to borrow increases. Supply increases, demand increases, rate increases. Restrictiveness means added restrictions put on borrowers, points on a mortgage, higher down payment, more collateral, bond covenants for business borrowers. Lack of restrictions is attractive and would encourage borrowing. An increase in taxes reduces the incentive to invest or save, but tax deductibility of interest by businesses increases demand. Foreign investors benefit from appreciation of their own currency, which would increase supply and lower domestic rates. Expected inflation would decrease supply, as suppliers of funds will be repaid in dollars worth less, but borrowers would be repaid in dollars worth less, so demand increases and rates increase. I** of J is the equilibrium nominal interest rate for a given security. This primarily applies to debt securities. Let's look at each component. IP is the inflation premium. It's based on the Consumer Price Index, CPI. RFR is the real risk-free rate we discussed earlier relative to the Fisher effect. Note, the first two factors, IP and FR, are common to all financial securities, while the others can be unique to each individual security. IP plus RFR is the observable risk-free rate. The default risk premium applies to non-Treasury debt securities. The Treasury will not default on our debt. Corporate debt will have varying degrees of default risk. LRP is the liquidity risk premium. It applies to non-Treasury debt securities. Treasury securities are very actively traded. Corporate debt is very inactive. SCP, special provisions, security-specific risk premium. And MP, a premium for longer maturities. It applies to Treasuries and corporate debt. The longer you want to hold my money, the more premium I want. As you might expect, the default risk premium on corporate debt securities varies over time, in sync with swings in the economy. And also, as expected, AAA bonds have the lowest default risk. with the BAA line closely following the pattern but at a higher level. This graph shows three possible directions of the yield curve. Upward sloping, A, is the most common, and we'll talk about why that is. Upward sloping indicates markets expect long-term rates to be higher than short-term rates. The B curve, downward or inverted, is not the norm, but it can occur. Downward sloping indicates markets expect long-term rates to be lower than short-term rates. And the C, flat, very rare. Markets expect rates to stay flat. The yield curve does invert. Here's data from 2019 when we did have an inverted curve. One of the main theories related to the shape of the yield curve is the unbiased expectations theory. Basically, it maintains that current long-term rates can be inferred from current and future expected rates. As complicated as this looks, we'll go through some examples of how it actually works. This assumes no interest rate volatility, and note that these rates should be zero coupon rates, called spot rates. Same equation, but put into a formula. You may not have seen the pi symbol. Consider the sigma summation symbol that says add up everything to the right of the sigma. Pi says multiply everything to the right. It's a geometric average, and an example is coming up. A more detailed demonstration of this example is on the next slide. You want to find what the 3-year rate today should be. That's an annual rate today, 1, for 3 years. R1, 3. You can observe the 1-year rate right now, R11, 10%, the 1-year rate at year 2, R21, minus 15%, and the 1-year rate at year 3, R31, 12%. Given that data, the 3-year rate today should equal the cube root of the product of these 3 annual rates. Remember, you have to add 1 to each rate, then subtract it out at the end. So you're seeing your formula, R13 cubed is equal to R11 times R21 times R31 minus 1. You can see our result, 1.55%. The Excel symbol works it out in Excel, and it's posted in Blackboard. Long-term interest rates are geometric averages of current and expected future short-term interest rates, plus liquidity risk premiums that increase with maturity. A competing theory of the yield curve is the liquidity premium theory. This is an extension of the unbiased expectations theory with the addition of a liquidity premium, the L's. It made it more complicated. These graphs illustrate the effect on the curve of adding the liquidity premium. In all cases, adding a liquidity premium shifts the curve upward, even converting an inverted curve to an upward sloping curve. A third yield curve theory is called market segmentation. This posits that investors have maturity preferences, meaning I may always want to invest in 10-year notes, and I'll only deviate from that when the compensation is sufficient. Given this theory, rates within maturities are determined by supply and demand within that maturity band. Implied forward rates are exactly as named, implied. Using observable rates, we can imply future rates, and we're going to go through examples. This is example 2.4 from the text, and we're going to go over it line by line on the next slides. We are given a 1-year rate beginning in year 1, 0.553, a 2-year rate beginning in year 1, 0.774, a 3-year rate beginning in year 1, 0.905, a 4-year rate starting in year 1, 1.278. Look at the graphic to get a better idea of what the given data means. The 2-year rate beginning in year 1 of 0.774 means 0.774% per year for 2 years. The graphic details what we're looking for, the pink cells. Given a 1-year rate starting in year 1 and a 2-year rate starting in year 1, we can imply a 1-year rate starting in year 2, R21. Simply put, the 1-year rate starting in year 1 times the 1-year rate starting in year 2 must equal the 2-year rate starting at year 1 squared. It's a 2-year rate. We follow the same methodology to find the other implied rates. While I'm showing these as R12 for simplicity, we always add 1 when multiplying, then subtract 1 back out at the end. And on the next slide, we'll walk through the example in some more detail. The first part of the example is shown above. Given a 1-year starting at year 1 rate and a 2-year rate starting at year 1, we can simply imply the 1-year rate beginning at year 2, the blue cell. For computation, all rates are added to 1, then the 1 is subtracted out at the end. The logic is, to avoid an arbitrage opportunity, the product of the two 1-year rates must equal the 2-year rate. To see this in Excel, click on the Excel icon. The example is also posted in Blackboard. I'm going to stop this on Chapter 2 now. The rest of Chapter 2 is a time value of money review, and I'm going to record it as a separate lesson.